guys, welcome back to the Capital Mindset Show. Today's going to be a little bit of an announcement in the beginning, and then we're going to be talking about what it is today's theme is. Okay, so today we're going to be first talking about the unfortunate event that I apologize for. There was a video that was supposed to come out today, and the date is 1/24/2022. The video was supposed to encompass a little bit of an announcement about what's going on in the market, my thoughts on it, hopefully to provide value. Unfortunately, there was a copy strike against it, so hopefully within the next 48 hours it'll be out there, but unfortunately the information won't be as fresh or up to date. So this video here will for sure be out, and it will contain some of the themes discussed in that video. If you watched that video, I hope you really enjoyed the meme, which is the reason for it being actually copyrighted or copy strike. So that being said, today's discussion is going to be centered around the market turmoil. So for those of you who've probably been watching, the market's kind of been coming down, a lot of different positions, depending on what you're invested in. Not every position, and we'll discuss a little bit about that. But for the most part, you see a lot of speculative assets. That's what I've been calling speculative assets. And I'll discuss two videos. It'll be a little bit of a quick update for Tattooed Chef, and I will also be doing Corsair, right? So, because I know some of you may or may not be interested in that, but that is, a good example. And then we'll look at the price action at a bunch of them to see what's been going on. But I'll start the video off with discussing leverage. Okay, so the system we've discussed in other videos in the past, right? If you've watched this channel for quite some time, there's been a lot of leverage in the system. And so we discussed this in videos in December, and there was a video in December 16, 2021, posted on this channel where I discussed the main large shift in strategy change for me personally, and where I was shifting my focus towards cash equivalent positions or cash. Right. And so I was taking profits. So many of you probably have seen when I sold, for example, Bristol Myers Squibb, even though I thought it was a good investment, but I said there were clear reasons. I sold Intel, for example, and that one was because I just didn't want to hold it, right? Because I disagreed with the management, but I wanted to hold cash or cash equivalent positions, right? So I would have preferred to do that. And there were a couple other investments, right? And that's excluding the speculative additions, because I did make some very small speculative additions to the portfolio, including the Chinese VIEs that also I bought in December. I still hold those, and I have basically the entirety of my speculative assets, except for I trimmed, of course, one of them, and I discussed that one in another video as well. But I trimmed that one way back. Okay, so it's not a recent trim. But there was kind of like a discussion to be had in the video that was supposed to come out today. What the heck is going on? All right. So margin rates, or at least the fear of rates rising, is going to bring down the margin levels. All right. And then we'll discuss the carrying call, or not the carrying call, the canary in the coal mine, which was kind of telling us that this was a possibility. And again, I discussed in December 16. That video was actually made before December 16, but it was posted on December 16. What was going on? There was a yield curve inversion, a little bit of details around that, and then how my cash equivalent positions, the strategy was that should there be turmoil in January 2022, which we're kind of seeing right now, that would be to the best scenario for me. That was what I basically said in that video. And then there were some little tidbits here and there and some macroeconomic videos where we discussed a little bit more of the nuanced details about yields, what the Fed is kind of stuck in, so stuff like that. I guess also what we'll begin is kind of looking at one of these canaries and kind of show you guys what's been going on. So you see here in November, we started to see a little bit of deleveraging. This is ARK Innovation, highly speculative, I think objectively highly speculative. And right here, we saw the first drawdown. And then you see a little bit of stabilizing in December. So that was the first sign, right? You might think there's two ways of looking at this. You might think, okay, well, it's down, I should buy because it's going to go back up. Not necessarily. No, bad decision. All right. And in hindsight, it was a bad decision, but very bad decision, because if you looked at the rates of margin, right, the dollar amount of margin, it was actually declining in November and in December. And then you had yield curve inversion in December. So that should have told us that speculative assets were a high risk. So you should take risk off the table for speculative assets. And then if you remember, there was a video that was posted, I think that was very early January. I think it was very early January. And that one was where I discussed basically selling out of the entirety of REITs, except for basically a watch position in Vici properties. And then the reason for that, again, was the scare, the potential of rising rates, right? And then that would raise the cost of capital of REITs, et cetera, et cetera, et cetera. And I wanted, again, to fulfill the strategy that I was discussing in December, which is cash or cash equivalent positions. And I began the discussion of that strategy in November, but more heavily going actually into it in December. And in hindsight, it was a very good play because my portfolio has basically actually remained flat or gone up slightly while the market's actually come down a bit. Okay. So another speculative asset that we'll actually discuss is, for example, AMC, right? We have AMC. So another highly speculative asset, down 17% today. Ooh, actually, I didn't even know that. And then let's take a look at, let's see here, Shift Technologies. And then we'll look at Smile Direct Club. Smile Direct Club, okay, Shift's not that down that much today. SDC, okay, not down that much today. But, you can kind of see, and the theme is still extended over the past 6 months, right? So you see the drawdown November, and then just kept drawing down, right? Highly speculative assets. This is the canary in the coal mine, right? Should have been kind of telling you. This is always the case, by the way. History really rhymes. Every single time that there's kind of like a pop in a bubble, the speculative assets go first. Okay, always speculative assets go first. And then let's actually take a look at I think, let's see, very good food company. This is a interesting company, to say the least. Yeah, so that's down a lot. Let's see, Peloton's another one that I had no idea. This is one we were laughing at the office, like what the heck was going on, and why were these YouTubers even claiming that this thing was gonna double, triple? It was silly. This is actually one of the inspirations to actually start a YouTube channel, because I don't know, man. I don't even know what to tell you. The level of analysis was actually quite shocking. Yeah, so we're seeing the same drawdown. It's kind of coming back. I don't know. And now there's the whole news that came out with them trying to get rid of the CEO and then put the company up for sale. I think that's the best option, if I'm being honest. Let's take a look at GME. That's another retail. Well, I wouldn't say all retail investors, but we can kind of ascribe it to, yeah, you see 17%. Okay, so this is the theme I'm hoping to showcase to you guys now. This is what's going on. And the thing is, this is if we had been taking information, for example, from, I would call the responsible YouTube crowd, right? The responsible YouTube crowd versus what I call the hype investors. Okay, the hype investors were the ones pushing these kinds of assets, and unfortunately, those who listened may have been burned. And I hope now it's kind of like a lesson that going forward, you shouldn't really do that. You should do your own research, even more so than you really think. And you need to have a good foundation, understand what you own, understand why you own it, and have a strategy. Very important to have a strategy. So there are some speculative assets, for example, that we discussed on the channel. And by the way, I still hold, again, all the speculative assets. So for example, and by the way, all the speculative assets in totality of all my wealth is about 7.58% of my total wealth. And then some of these speculative assets include, for example, Zillow Group. And then in that video, for example, I'm a terrible salesman because I say to you, it is entirely potential. There is nothing really underneath this company as of yet, just purely potential. For example, I'm a terrible salesman. I'm never going to tell you this company's going to double. I'm saying it's worth the speculation, in my opinion. And then I always say the word speculation. You can go back to those videos. And that is why you'll never see on this channel me saying this stock will 10x. This is another one. And again, I said the words, this is pure potential. And I'm not investing in it for this furniture business. So the analysis I put there is a brief summary of my thought process. If I'm not investing it for the core business, I have to put it into the speculative bucket, and I have to be strict on myself, right? And it turned out to be really good, because this one, I still haven't even finished the position at all for even a speculative size position. I'll tell you how many shares I have. That's how small it is. I have I think a total of 30 shares. This is an extraordinarily small position. And so I'm actually happy a little bit because I can add to this and, finish up the speculative sides, which it will constitute about 1% or close to 1% of my portfolio. So again, those are the speculative, but you see, like, you have to be able to separate speculative assets versus strong assets. And the unfortunate thing is there was an asset I actually added to recently, and I was going to make a video on it, but the the darn thing went up. So there's no point in me adding a video to it, because what happened was I added on the dip when it was GlaxoSmithKline was going to be bought out. That was the announcement. And Unilever was a business I've been having on my watch list, and I bought, just the starter position. I was going to add more if it kept going down, and I thought I was going to stabilize, and I was going to release a video kind of discussing my thoughts on Unilever. And then the darn thing just like got out of the nibbling zone. Now it's back to where it was. So I might actually just sell this one. I'll still make a video on this company just because it is a good company. It's a solid business. And it's one that you have to really acquire at a good price. It's not something you just buy whenever. I mean, I guess some people think that strategy is viable, and maybe it is viable. But the point is, I'll try to make a video on this company. I am not going to make the same kind of video because I was going to make a video like why I'm adding, etc. So some other kind of speculative assets that I actually want to go over is the all famous tattooed chef. And I'm actually going to go over a valuation model, revisit it, because the last one we did was quite a long time ago. Oh, down 13%. Okay, I did not know that. So this one's down quite a bit. And I guess we could see the same theme of deleveraging. So yeah, November, you don't really see that here. But this one's really pushed by one of the largest channels. And let me be frank, because I'm not the type of person that wants to be too blunt all the time. You can ask, for example, Austin or anyone in my inner circle, or when you get to know me, I don't like to shoot down someone's investing idea. I like to just be subtle about it. There's one that's like, I think it was called Context Logic, and a mutual friend of ours recommended. That one was a little more overt that was a terrible business, but this one is a terrible business as of now, and they don't have the scalability that I would witness. Actually, my wife just tried the products, by the way, and she actually thought it was terrible. I never really tried any of the products, but let's take a look at this valuation and see what we come up with. So remember, some of revisiting the price target, the model told me that this was worth it at about $2 a share last time. So we'll see if anything changed. And in the last video, we discussed that there would be accounting changes coming in December, and the company announced to you. So, and that specific content creator did not feel the need to explain that to the audience. So this goes to show you that you see, like, usually I'm subtle, but I'm going to be overt now. That individual is so devoid of financial literacy. I can't even tell you. The individual simply looks at forward price earnings of analysts. Can you look, for example, everyone, can we just appreciate what the analysts say about this? Okay. And then when you can understand, like, for example, I hope when everyone goes to work, right? When you didn't get into that field, you probably thought the people in that field knew exactly what it is they're doing. Well, then once you get into the field, you kind of realize that people in that field don't really know what it is they're doing. All the adults are just children. They're just bigger children. Okay. Well, that's kind of like the same thing with finance. All right. So you'd start to notice a lot of these analysts are just children, and they don't know what it is they're doing. Right. But they have a fancy title, et cetera. All right. So with this one, I think we discounted at 20%. We assumed that they would at one point achieve a profitability ratio, something close to Canaries, which is about 10%. And then let's actually discount it at 15% first. And then let's do crazy rates. So let's take a look at their, okay, so we can probably do like 50%. Okay, 50%. All right, I had to make some quick adjustments actually, because there was something going on with the cash flows. But anyway, we're back to normal. So now we have a discount rate of 15%. We assume that 50% growth rate for the next 10 years compounded, so that they have to see growth acceleration. We're assuming the margins closer to Canaries over time. And how likely is that within the next 10 years? I don't know. We're kind of making assumptions there. And for example, I wouldn't think this discount rate's appropriate. Buybacks, I don't assume that they're going to be able to buy back any shares anytime soon. And I won't assume dilution. How about that? I'll try to be impartial in that sense. So I'll say no. And if we say, for example, I want to showcase this to everyone. So if we say 50% here, 40% there, 30% there, and then we say, I don't know, 26% there, 20% there. Okay, so if you, these are the growth rates, and if you assume any of these growth rates, or you can pick whichever one you believe the most, there you go. So by the way, just so you guys know, 15% rate of return would be about 304% rate of return over 5 years. Nothing what that individual was even claiming, by the way. And we're making the assumptions on margins that they would be the same as the largest company in that respective field, or one of the larger companies, not the largest, but one of the larger ones. So let's say you wanted a greater margin of safety or a greater rate of return than 300%, because remember, this individual promised about 10 times. And when I say the word promise, I'm not saying he said for you to invest in it and that you would make it, but the implication by him saying in a video like that is that some individuals would make a great rate of return. So let's take a look at 20% discount rate or 20% required rate of return. You can see here, it's not there yet, right? And this is actually where it comes from, where there was about the $2 price target, because I think we did assume some dilution probably, but it's around here. So this is kind of where I more or less believe the growth rates could be if they do grow. And I do think they're going to dilute you, because that, remember, this is the other thing that irks me a little bit, but this individual said that if a company doesn't need to dilute, like if they're not desperate for cash, you're not going to dilute you. No, that is false. That is false. That is false. That is false. They're going to do, if the CFO, the CEO, the management team is good, they're going to use the lowest cost of capital. If that means equity at the time, they're going to use equity. If the debt markets aren't going to give them a good rate on their cash, they're going to go to the equity market if the equity market is a better rate, because they're supposed to lower their cost of capital. Okay. Now, ignore their estimated WACC. There's a bunch of funky accounting stuff going on. His company's fairly new. But yeah, kind of highlighting this, you see the buy rating from analysts. They are implying a 95.7% upside if you're buying now. Remember, when the original video came out, this was significantly higher. And now where we are, this is now about, $10.99. So this is still too speculative for me, because I'd have to assume 50% growth rates. And I'm still not just there yet, but 50% growth rates. And I cannot assume dilution. No, not for me. Definitely not for me. And I hope that's kind of clear. And you can understand why this is selling off now. Now we're seeing the pop in the speculative assets. Okay, let's move on to Corsair. Corsair is less speculative. Corsair, again, you have Eagle Tree Capital, so you won't have that much volume as much as something like this. But Eagle Tree Capital, again, I'm nothing against them. I actually know one individual who does work. I won't say their name, but that person I know is good reputation in my books. All right, so let's do CRSR. Let's go for it. All right, whenever that decides to load, let's go ahead and secure some growth rates. Okay, so let's look at the analyst again. Oh, and forward price estimates. Okay, it says a buy, price target of 30.56, 70% upside, guys. You see right there, analysts, just listen to them. All right, so let's take a look at some of these growth rates and ignore this buyback. That has to do with some accounting stuff that was before they were public. Ignore that. They did not actually buy back those shares as it pertains to you as the public investor. All right, so let's take a look at some growth rates. So let's assume they continue this growth rate forever. And we have to discount it. So let's start at 15%. So if you think they're going to continue this growth rate, which is highly unlikely, because I'll put an asterisk on there. We went through a one-time period where their sales were brought forward, and then that's increasing the average growth rate. That's why they went public, by the way, because Eagle Tree Capital probably knew that. Okay. And they wanted to take out their cash. Okay. So not that this is a terrible, terrible, terrible business. It's just you have to buy these at the right price. All right. So 15% discount rate, 28% growth rate. And let's actually now assume that it's the high point, because we know it's a buy there. And let's see what happens if we lower that to 20%. Okay, we're there. We were just there actually. Okay, so now we're below there. And then now let's assume 15. Okay, we're not there for a 15. Let's do 10. And then we know, for example, I don't need to give you 5, but 5%. All right. So if you assumed a 5% growth rate from here in the cash flows, then yeah, you got to buy this at $7. And we're assuming no dilution. And I won't assume buybacks. I'll be just neutral on that. All right. If you want to get a 20% required rate of return because you believe there's a lot of uncertainty, you need to get this at a good price. Well, there's your numbers, right? So if you think it's going to grow at 15%, you still need this to come down all the way to $9.62. Do you see what's going on. And the cash flows are going to be coming down and the margins might be coming down, right? Because we have to understand the nuance of every business. So you have to not be greedy when others are greedy, right? You have to be kind of fearful when others are greedy. And so when you have an individual who espouses some sort of financial literacy or espouses that he has financial literacy and simply uses forward price estimates, then you gotta be a little cautious there, especially if they're just using, like, for example, PE, right? So look at this PE, but a price to free cash flow of 29.77, right? Very misleading accounting, right? So you don't need to be an accountant to understand these kinds of nuanced details, but it does help. And if you guys want to learn, you guys can, there's a bunch of free, no need to pay anyone content out there that provides the information necessary to kind of understand what this is. A little bit of accounting. You don't need to pay anyone. Do not pay someone $20,000 to tell you to buy something like this. And that's why again, I'm mentioning or hampering down on that individual so hard, is because it's quite egregious what they're doing. And frankly, yeah, just disgusting. All right. So this is kind of my thoughts on that. And to kind of summarize again, when will it be time to redeploy capital? Pretty soon, actually. So now that we're seeing the quote unquote panic, or we start to see people panicking, I think people are going to start panicking today. Okay. Things are going to start to get interesting and they're going to get really fun for me. This is the times where, before it was a little bit boring because it was very hard to find anything to invest in. And it was very boring being mostly cash or cash equivalent assets. So now I'm going to actually, I think this is the time for this channel to shine, because there's going to be a lot of different assets that we can evaluate and see what's out there, so we can redeploy capital. And I guess, well, especially at work, it's going to be a lot of full days, a lot of different, taking a look at different things. But we have to bear or see if this is going to continue further, get worse. And then we need to be prudent with our capital. We can't be too hasty. We can't just jump in, buy the dip immediately. And remember, if you're an index fund investor, you're supposed to dollar cost average in. Okay. So you're not supposed to care. Okay. This is for those who are trying to pick individual companies, right? You find a company and you don't worry too much about the macro backdrop, right? The strategy is simple. Buffett even says this: just calm down, ignore it, find good businesses, pick that good business, invest in that good business. That's it. Calm down. Don't worry about anything else. Okay. So then get your watch list ready. Start noting these things down. Start noting different companies down. Do your analysis. Set up your buy prices. When do you want to buy this business? Be honest with yourself. Be very honest with what price you're going to buy. There's no one forcing you to buy that asset. You can love the company, hate the stock. Two different things. Company and stock are two different things. And then you set your price that you want to own it at. If it goes up from there, who cares, right? There's always a new opportunity. Okay. So on that note, guys, again, I apologize. I'm very sorry that video didn't come out. I know that if it does get approved by YouTube, you guys will enjoy the little humor in the beginning. It will repeat some of the information here. There are some things I mentioned in there that don't mention in this video, but I tried to cover it best I can, some of those details, but I wanted to get this video out to everyone. On that note, guys, if you guys like content like this, please feel free to leave a like or share this video with people who you think may need to see content like this. Again, if you guys have any stock requests, leave them down in the comments below, and I'll sure to add them to the list. And if you guys want to see more content that's kind of about different topics, also comment that down below. Those are going to be separate from the request videos of stocks. Those like conceptual videos or sector analysis videos, I'll do those actually separately. On that note, guys, have a good one. Thank you for watching. Bye.